Hello everyone, welcome back to the SPAC Arena. Today we've got SBE Chargepoint. I know you guys have heard about this company. There's been a lot of hype in the past week. So this is a company that's working on the electric vehicle infrastructure. They make charging stations. But is it worth investing in? Is it a good buy? That's what we're going to talk about today. You guys know the formula. In the beginning, we're going to talk about the company itself, what it's done, where it's going. Then we'll talk about the market, then its financials, and then we'll look at the stock itself, how it's been doing, and if it's a good buy right now. So let's get into it. But of course, please like and subscribe. It really helps out, and I really appreciate it. Thank you. All right, guys, before I get into the review itself, I need to mention that so far this year, as of me filming this, there have been 6 SPACs that have focused on EV companies. And if you look at the HCAC Canoe investor presentation, the management mentions that they've performed 15 meaningful reviews of EV and advanced mobility companies. So there are a lot of different EV companies out there. And as more and more get selected by SPACs and merge, well, the pool of quality companies starts to shrink. So that's why a lot of analysts and a lot of investors now are starting to look at what are the peripheral opportunities when it comes to the EV market, right? We all agree that this is a great industry that's going to grow in the future, but now as the pool of companies is starting to shrink, now we're looking at the other opportunities. So you can think of Graph Velodyne and GMHI Luminar for self-driving. Then you have ChargePoint, which is more the infrastructure and the charging stations. So I just wanted to remind you guys that now this is why we're looking at not necessarily EV companies themselves, but companies that are going to be supporting that industry. So let's talk about the company itself, its products, and its technology. So unlike some of the newer SPACs that have no revenue and don't have products in the market, ChargePoint has been established since 2007. So you're betting here on a company that has products in the market and it actually has customers already. They have tens of thousands of charging stations in the market right now. So you're not just betting on an idea, right? You're betting on a real company. So they consider themselves to deliver a fully integrated EV charging solution with a comprehensive portfolio of hardware, software, and services. The SPAC has 317 million in cash in its trust account, which the company is going to receive, plus 225 million in the pipe. So basically, the company is going to have a lot of cash to deploy new charging stations in the future and continue its R&D. The transaction is valued at 2.4 billion. I looked through the leadership, right, and I didn't notice any red flags, nothing that really stands out, so I'll kind of skip over the management for now. Now, this is what they look like. This is in Germany, right? They have a big presence in Europe, and you just plug it in and you charge your car. So this is one of the great slides, right? It shows you the huge network that they have. They have thousands of charging stations throughout the US and also Europe. I mean, Europe is forward thinking when it comes to electric vehicles, so they have a pretty big presence in Europe already. And then YouTubers love to show this graph, which talks about their market share. They're 7 times bigger than their nearest competitors. As you can see, 73% market share compared to 10% for Sigma Connect and 8% for Blink. So as you can see, this is clearly the leader for companies that make charging stations. So the one thing on this slide that no one's talking about and has me a little bit skeptical is the bottom addendum here that says that this refers to connected charging of certain specs, right? So 4 to 5 hours to charge a 100-mile range battery, typically serving 3+ drivers per day. That's not really impressive. This is for their basically home technology and office technology, right? So this is where they're currently strong is like if you're just going to work and coming back and you only need maybe like 50 miles of charge or something like that, then it's okay. But when it comes to long distance driving, because the current models of electric vehicles, they're targeting 300-mile range, and the next generation, right, the one Tesla's working on right now and other companies is going to be 500-mile range. So you can't just sit at a charging station for 25 hours because you're trying to go visit someone in another state. So I do know that they have other products that are trying to address this problem that charge much faster, right? Like this one, this is their Big Daddy charging station, their biggest model. But the thing is that they don't give us any information about what's the deployment of these bigger charging stations. Like if you look at their product, right, they have a lot of different types. So they have this one, like they have this one for the fleets. They have this one for the highways. So they have different types of charging stations, but in the investor presentation, they just don't give us any details about it. And that's a problem to me. Now, their business model is solid. I do like it the way it's structured because you have the hardware, which in itself is not appealing. Like, there's just generally not a lot of margin in hardware, and other companies can try to undercut you. So that in itself wouldn't be that exciting. But where it gets a lot better is that they're also going to be making money with the software. And as you guys know, because I've talked about it in many other videos before, there's a lot better margin with the software, and that's where the money is. So technically they can almost break even with the hardware to try to get as big of a deployment as possible, right? Undercut everyone just to have their charging station in all of the relevant places, and then make most of their profits eventually through the software. So that's the way I see it, right? So I like this business model. I don't see any problem with it. And then there's the services, that's just servicing the stations and the warranty and parts and labor and stuff like that. So again, the business model itself is okay. I like it, but I'm not sure exactly how they're deploying their different products, and I wish they gave us more information about that. So now we need to talk about the size of the market and how are they going to be monetizing this company. Well, here I don't need to really convince you guys about the electric vehicle industry because I believe that you're already convinced. Otherwise, you wouldn't be watching this video. It's pretty obvious that over time there's going to be more of them in the market than there is now. And because of that, by default, Chargepoint is going to benefit. Like, they're going to catch that wave without having to really do anything. And that's why it's very powerful investing in segments of the market that are growing, because you have that tailwind that really helps your company by default, right? They don't have to do anything for that. So another one of the tailwinds that they're talking about is the fossil fuels ban, right? You have states like California that want to go green and ban the ICE engines by 2035. So of course, again, that means more electric vehicles coming into the market, and there are many other states that are going that direction. So here, so what they're saying is that it makes sense, right? As the electric vehicle industry grows, ChargePoint is going to grow proportional to the EV penetration. So personally, I'm not going to be buying another car until it's an electric vehicle with level 3 self-driving. I'm sure a lot of you are the same. So over time, it's just everyone's going to want one. So how does that look like? Well, here, when it comes to the unit economics, they don't really give us any numbers. And again, that's one of the weaknesses of this investor presentation. Like, why are they hiding the numbers? They only give us percentages, so that's not good. So 51% is the hardware part, like when they're selling one and installing one. Then they plan on making 36% of their revenues through the software. And this, as I mentioned, is where they're going to get pretty good margin. And then 13% is the warranty and servicing and all of that. Again, where are the numbers? We don't know how much money they're making per unit. Like, if they're breaking even, just say it. Like, just tell us that you're going to be making money with the software. There's no problem with that. But they're hiding the numbers. So on this slide, they're showing us their customer growth and retention. This is very good. It means that their customers are happy with the products, and because of that, they're buying more over time, especially the business consumers. So in a Fortune 500 company, on year one, you have $33,000 in spending, which isn't that impressive. But then after year four, you're up to $506,000 in cumulative spending. So as their employees need more charging stations, they just keep going back to ChargePoint, and that goes to show the retention. Like, once those are installed, they're going to be making that money through the recurring revenue from the software for years and years and years to come. That's why the model is so powerful, is that once it's installed, they're kind of stuck with it. So here with their top 25 customers, right, they have 14x cumulative spend. So as every quarter that goes by, they just keep spending more and more on the network. And now we get into their financials and their revenues, and this is where it gets a little bit more troublesome, because think about it. This is a company that started in 2007, and after 13 years, they still haven't managed to turn a profit. In fact, they're losing tens of millions of dollars per year. So what's going to change in the next couple of years that's going to really help them become profitable, right? They expect their own projections to be losing money in the next several years too. So again, let's just look at what they tell us. first of all, they're talking about the units shipped. So in 2019, they had 32,136 units shipped, and then in 2020, they had a small dip because of the pandemic at 31,623. So fairly even, like no growth, but no real significant dip this year. Same with the revenues. 147 million in 2019 and a small dip to 135 million in this year. That's their projection. But now they're projecting pretty exponential growth right over the next several years, and they will get a lot of money from the SPAC, so maybe that's what they're counting on to have that big growth in their network. But considering that in the previous years they only grew by what, about 25% per year, we'll see if they're able to execute. All right, and this could be the most important slide in the entire investor presentation. That is the margins. And this is where I have another problem with the company is this doesn't tell us anything. Why was the margin 13% in 2019? Why is it 20% in the first quarter of this year and 24% in the second quarter? And what is their plan on getting to 42% in 2026? Right? Of course, as there's more widely adopted electric vehicle in the market, right, each charger is going to be used more, and that's going to be better for the company. They're going to make more revenues per charging station. I mean, that's pretty obvious. But this chart by itself doesn't really give us any indication of what their plans are and how they're going to actually execute on this. Like, what's their deployment strategy? They don't give us anything. So if they can increase their margin right through the software, that's great. But again, we don't get any information from the investor presentation. So I guess they believe that we just have to take them at their word. So when you look at their financial projections is when you get a clear picture of the company, and that is their expenses are too high and they're just losing money every year. So right now in 2020, right, they have 135 million in revenues projected, but then look at their expenses at 140 million. So where is that money going to? I'm not quite sure from this investor presentation. Like, are they spending heavy into R&D? Is there a lot of installation costs that they're eating? Like, where is all of this money going? Why are they losing so much? So for 2020, loss of 97 million, that's going to grow bigger next year at 121 million, and then they are not going to start making profits according to their own projections until 2024, where they would be making 86 million, which is a 9% profit. So why is that? I mean, I really not sure what the pivot point that's going to make them profitable after 20 years. Of course, each station is going to be used by more users as like the network gets bigger and there's more people on the road that have electric vehicles that need to be charged. But again, it's their job to spell it out for us. It's not my job to decipher how they're going to suddenly start making money after 20 years. And, you know, their argument isn't that convincing to me personally. So anyway, so here they believe that they can significantly lower their expenses over time, and that would really help them. So 2018, like they had 137% operating expenses. So that's why the company is losing so much. They believe that as their revenue grows, the percentage of their expenses is going to come down a lot, and that's how they're finally going to start making profits. But what is this from? Like, what are these cost reductions for 2020? Is that employees that they fired? Like, again, there's nothing that tells us anything in this investor presentation. So looking at the pro forma, you can see that they underwrote it at $2.4 billion. The SBE shareholders are only going to own 10.3% of the merged company. That's not a lot for 31.4 million shares. So that's going to have low float. The volatility is going to be high because it doesn't take a lot of buying or selling to move the share price. So that is not great. In total, there's going to be 304,900,000 shares. And what you want to do to get the current valuation is multiply this number by the current share price, which is, as of me filming this, 15.39. Then you subtract the money that they have in their account, right, and what they'll get from the SPAC, which is 648 million, and you get about 4 billion right now. All right, guys, in the close, the most important segment. What do I think about this company and how am I going to be playing it? Am I going to be investing in Chargepoint? Well, I'll be honest with you. I know that there's been a lot of hype from other YouTubers talking about this like it's going to be the biggest SPAC of the fourth quarter, but I'm very skeptical about it. I'm not nearly as bullish as they are, right? I do see a case for it just because they're at the right place, right time, but I do believe that this company that's kind of opportunistic, like they're going public now because EVs are very hot and they can get a very high valuation that they normally wouldn't be able to get. I mean, the company has been around for 13 years. They still do not know how to make a profit, and they won't, according to their own projections, they're not going to be making a profit for the next 3 years. They simply don't know how to turn revenues into profits. So you can tell me in the investor presentation that you're going to increase your margins and you're going to grow a huge network all over the world, but until you convince me that you're able to turn that revenue into profits, because they wouldn't show us the economics for any of the units that they're going to be selling, until then, I have to be skeptical about it for a long-term buy and hold. Personally, at $15, I'm not going to be investing in it. $4 billion valuation. If it drops to back to like 11 or something like that, I'll look at it again. But when it comes to long-term buy and hold, there's just other companies I like better than this one so far. So I have to go against the grain on this one. Now, when it comes to momentum plays, I do believe that this is a strong contender. This has a lot of meme stock characteristics. So people have been talking about it overly positively, right? You guys know this. You guys know the symptoms, quote unquote. People are very bullish. They see all of the strengths of the company. They don't see any of the weaknesses, right? They only focus on the strengths, and that often turns the stocks into meme stocks. And for that, there can be a lot of short-term growth from it. So this, when they announced it, it peaked at 1640, which, considering the previous crop of SPACs didn't really spike much, this is fairly good. Right now, it's on a small downtrend on MACD just because the market's fairly weak in the past week or two. But I do believe that as we get closer to the merger and the current crop of SPACs ends up merging and people start to move their money to other SPACs, this one is going to have a lot of attention. It keeps getting good reviews by people on YouTube and on other forums. So look for this stock in terms of a short-term momentum play. But for myself, I'm not quite sure long-term. Like until they actually tell me what's the pivot point that's going to turn this company very profitable, I'm just going to pass on it. So guys, I hope you enjoyed the video. As usual, let me know in the comments what you think. Tell me what am I missing? Like what's going to make this company wildly successful and very profitable and not just build a big network but still lose money. I'd love to hear your comments. I know a lot of you are very bullish on this company. We'll talk about it. And I'll see you guys in the next video. Please like and subscribe. It really helps out.